jams. So we are connecting after a gap of about 2 months. So to kick off the proceedings, so as usual, we'll start with the update on the performance. So starting with the Rising Giants return performance, nothing new in this. So Rising Giants PMS is about 15 months roughly old now. So since inception, the portfolio is down around 21%. And I think everybody of you are aware of the returns. But just to highlight some positive things over here is that when you look at the right-hand side table, we have broken down the returns into various time periods. So you'll find that there is a time period over there which stands out, that is July to September quarter, where the returns were not only positive, but we also kind of able to beat the benchmark BSE 500. And also in the last 1.5 months, there is a semblance of some stability in the returns that we are seeing. And coming to the retail champs performance, where we have a longer term track record. So when you look at the short-term time periods, the returns are similar to what we have in the Rising Giants portfolio. But when you look at the since inception figures, so we have just about, I think, 3.5 years old since the launch of the product. So the returns look healthy. So we are compounded annually close to mid-20s. And this is net of fees and other expenses, whereas the benchmark figures that you are seeing is gross of the fees and expenses. So when you look at the longer term time period, the returns are healthy. Even after last 1.5 years, we are into the negative zone. But despite that, since its inception, we are looking at a healthy return for the retail champs portfolios. Just goes on to say that if your holding period is long enough, I think you can expect a healthy return from the portfolios. But more importantly, we want to focus today's session on the portfolio fundamentals. So kicking off with the long-term fundamentals, and this slide we have been showing it in our earlier webinars also, but worth revisiting it time and again. So when you look at the long-term fundamentals of the portfolio, it is not only you'll see healthy compounding, but it is also quite consistent across the different time periods in the last 10 years. And mind you that the last 10 years have not been like a very blue sky scenario. So there has been one or the other macro headwinds or the disruptions that we've seen in the last 10 years. But despite that, you will find that when you look at the EBITDA column, for instance, you will find that the compounding is pretty much consistent and healthy around the 20% mark. And similar for the retail champs. And where before I go to the retail champs, but when you compare to the benchmark BSE 500, you will find there's a lot of divergence. So roughly, the portfolio compounded, fundamentals are compounded twice that of the benchmark BSE 500 across different time periods and across consistently. And coming to the retail champs also, longer term time period, unlike the conventional small caps, because we receive a lot of queries from the investor that is this a small cap cycle, etc. So unlike the conventional small caps, which follow a cycle where there are 2 years of very good earnings delivery, then 2 years of flat earnings, and then 2 years of negative earnings. Unlike the conventional small caps, retail champs track record has been again similar to Rising Giants, very, very healthy and as well as very, very consistent across different time periods. So clearly, retail champs stands out compared to the conventional small caps. And here also, when we look at the benchmark BSE small cap, the returns are significantly ahead of the BSE small cap that you can see across different time periods. And this fundamental performance is also continued in the recent quarters. So third quarter at the portfolio level, when you look at the second last and the third last row, you will find that the earnings compounding has been pretty healthy even in the recent quarter, that is third quarter. Despite some downward trend in some of the stocks, we will cover that separately. But when you look at the overall portfolio level, the weighted average EBITDA growth for the portfolio has been, again, very close to 20%. In fact, the 9-month return looks even more more spectacular. We have compounded more than 25% in the last 9 months. And despite some of the challenges, for example, for some of the companies rather, there was COVID-related revenues which are sitting in the YOY base. So that is one headwind. Similarly, we saw volumes getting impacted for some of the companies due to inventory destocking. In a deflationary environment, typically dealers and distributors, they go lean on the inventory. in anticipation that the prices will fall further. So that is one challenges that we have faced in the last 9 months, and particularly in the last 2 quarters. So that despite these headwinds, the portfolio compounding has been pretty much healthy, close to 20% mark. And a couple of drivers of it. One is that we have seen the gross margin, unlike the last 2-3 quarters where there was some margin pressure because of the raw material price inflation. We have seen some degree of stability in the gross margin. In fact, for nearly 50% of the portfolio, we have seen gross margin now seeing an improvement YOY, unlike the negative trend that we are seeing in the earlier quarters. And secondly, and more importantly, what we have been seeing in the last 2 years, these companies had invested massively into organic and inorganic expansions, into technology, etc., which is now started to bear fruits. So many of the companies will find that despite macro challenges, you'll find that the top line growth has been pretty strong. So large part of that credit goes to the investment that these companies have made in the last 2 years, and that has started to now bring into the additional numbers. And similar is the case for the Retail Champs portfolio. Third quarter at the portfolio level, we were close to 20% YOY growth in the EBITDA. And similarly for the 9 months, the numbers look even better. So in fact, at the weighted average level, we are almost 30% year-on-year growth in the EBITDA. The key message that we wanted to convey is that unlike the first 2 slides regarding returns, where the picture was a bit disappointing, the fundamentals tell a completely different story. So when you look at purely at the return and you don't look at any other things, I think the thought that you may come to your mind is that the fundamentals of this portfolio would have seen a significant downfall. So that is not the case. The fundamentals for the last 1 year, for the last 3 years, for the last 5 years, for the last 10 years have been very healthy, despite macro challenges that we have been seeing. So even in the last quarter and the last 9 months, the fundamentals of the companies remain in very excellent shape. And we are very confident that going forward also that will remain the case. What is the road ahead? So one is that we think on the gross margin side or on the margin side, I think things remain benign. So the prices of the key inputs remain fairly stable, even though there is some upward spike, small upward spike in the recent weeks. But generally the prices remain significantly below the peaks that we were seeing almost 3 quarters back. So on the right hand side table, you'll find that for most of the stocks, we are almost anywhere between 20 to 60% down of the peaks for the peak. So I think the margin, and given that most of the companies had high cost inventory sitting in their books for a large part of the last 9 months. So as those inventories or those inputs have got consumed, we think that the benefit of the correction in the underlying prices should start reflecting, to some extent start reflecting third quarter, but in a major way in the coming quarters, we think that that should start benefiting the margin. The only I think the only coking coal is one input where the prices remains very volatile. So we'll keep a close eye on this particular input price. But having said that, many of the companies have already started taking mitigating measures, like for example, they are bringing in more and more sourcing from renewable, like solar, etc. So again, but generally speaking, we are seeing a benign raw material price environment, which places our portfolio companies in a very good position from a margin perspective. Second is that for some of the companies, the YOY, as I said at the beginning, the YOY numbers were impacted because of the COVID-related revenues which were sitting in the base. So typically companies which were catering to the pharma sector, diagnostic sector, etc. So they saw a spike in their revenues starting from second half of FY21 and extending to first half of FY22. So as a result, optically, the YOY comparison for many of the companies were impacted. But as we move forward, we think that we should have more normalized base. So I think second half of first half of FY23 is where the COVID revenue started getting normalized. And as we head into first quarter of FY24, we should see the YOY comparison getting more and more benign, because there will be no major or significant COVID-related revenues in the base. So that is, again, this is one positive factor for the portfolio. Third is that I think many of you have raised concern that generally there is a bit of uncertainty surrounding the global environment. So will it impact the portfolio companies, especially those who are exposed to the global economy, export-oriented companies, adversely? So our answer, what we have written again in the newsletters time and again, is that when you look at the history of Indian companies, how they have fared to the recession in the West, we have seen only temporary or momentary impact in the demand or the revenues for these companies. For example, during the great financial crisis around 14 years back, we saw that revenues of the companies got impacted from second half of FY9 and first half of FY10. But then the recovery was pretty steep. So we are shown a couple of charts at the top hand side, where you see that maybe for a period of 12 months at best, the revenues get impacted, but then the recovery is pretty steep. In fact, we think that structurally recession actually is beneficial for the Indian companies, is for the simple reason is that during a period of hardship or recession, companies take a close look at their cost structure. And you know that Indian companies score very much high on the cost element because it's a low-cost destination. So structurally, what you're seeing is that every recession is followed by higher kind of sourcing to the Indian companies. So structurally, leaving aside the temporary impact, in fact, structurally, we think that the portfolio companies would likely benefit from a recession. And secondly, what additional layer of comfort we have specifically for our portfolio companies, and most of these export-oriented franchises that we have, they cater to very resilient end-user industries, whether it is to the food industry or to the pharma industry, diagnostics, where the demand tends to be relatively inelastic to the prices or the underlying macro situation, because it's very hard to believe that people will stop taking medicine just because there is a hit to the income or there is a macro, there is a recession. So that also helps, particularly our export-oriented companies, portfolio companies, that most of them cater to very resilient end-user industries. So in a nutshell, we are not so much bothered by temporary recession in the global markets. Having said that, I think talk about the recession has been going on for the last 1 year or so. So barring, I think, Europe, I think USA still the demand remains very, very strong. Looking at the commentary as well as the actual performance of portfolio companies, we're not seeing such signs of any slowing down of demand, particularly in the USA, which is the biggest export geography for the portfolio companies. So net, we think that the road ahead looks quite stable, remains sanguine about the prospects of the portfolio companies in the coming quarters. And the question that I think everybody of you will have in the mind is that, is this a good time to invest? Our answer is resounding yes. So we are trying to kind of give these two charts, which gives the answer why we are saying yes. One is that the left-hand side, when you look at the left-hand side chart, when you look from FY18 to 9-month FY23, you'll find that the portfolio's earnings, this is for the Rising Giants portfolio, has compounded. EBITDA has compounded at 22%, which we also showed in the table in the previous slide. Whereas the market have actually compounded at only 18%. So theoretically speaking, the market cap compounding should be higher than the EBITDA compounding, because many of these companies around 5 years back, they were much more fragile companies, in the sense that, for example, most of the Rising Giants portfolio companies around 5 years back, they didn't have a very strong FCF generation profile, because these were small companies, and hence their operating cash generating ability was very small, and most of that used to get consumed in reinvestment. So the free cash flow generation of the portfolio around 5 years back was pretty low. But over the course of last 5 years, and we have written that in the newsletter, also discussed in the webinar, the free cash flow generation of the portfolio has undergone tremendous change. For example, between FY19 to FY22, even though FY22 was not particularly very great year from the free cash flow perspective, because the company had loaded up on the working capital. But nevertheless, between FY19 to 22, the free cash flow compounding of the portfolio was close to 40% CAGR. So there is a significant change in the FCF generation profile of the companies. Secondly, most of the companies were pretty small. They had a high concentration of markets or customers or geographies or product segments. But over the course of last 5 years, many of these companies have undergone significant transformation. So from being single product company or single geography companies, they have now become multi-product, multi-geography companies. So they are much more diversified than what they were say 5 years back. Again, the balance sheet of these companies remains has surplus cash and etc. So, in theoretically speaking, the market cap compounding should have been higher than that of the EBITDA compounding. But because of the drawdown in the share prices that we have seen in the last 1.5 years, we are staring at a scenario where market cap is actually trailing significantly than the compounding in the portfolio fundamentals. So this one points to this figures point that say that this is absolutely the right time to invest in the portfolio. Second is when you look at the PE. Even though we are not big advocates of using PE as a valuation, but nevertheless, when we look at the PE also, you'll find that there is a significant derating which has happened in the PE in the last 1.5 years. In fact, what we are seeing currently, the PE, both the median PE and the allocation weighted price to earnings for the portfolio is very close to what it was, at the beginning of FY18. So again, the fundamentals of the companies have moved ahead, but the share prices have trended in a different direction. As a result, we are staring at a situation where there is the PE of the companies is almost similar to what it was 5 years back, despite again the fundamentals of these companies seeing significant improvement, the business model of these companies seeing significant transformation over the last 5 years. So we are very much convinced that for long-term compounding, given the drawdown that we have seen, or unwarranted drawdown that we have seen in the share prices of the portfolio companies, this is absolutely a right time to get into the portfolio. And similarly, when we look at 9 months also, purely concentrating on the last 9-month performance, you will find that there is a significant divergence or disconnect between what the fundamentals of the company's fundamental return of the portfolio and the share price return. For example, there is almost a 30% delta between the EBITDA compounding and the share price returns that we have seen for the Rising Giants portfolio. To smaller extent, even in the Little Champs portfolio. So we are talking about nearly a 20% divergence between the EBITDA growth for the portfolio and the returns that the portfolio has generated. Now moving to the specific stocks. So what we thought that generally our webinar is concentrated towards talking about generally portfolio in particular. We'll also touch base on some of the companies, not all the companies, but some of the companies where earnings have been a bit weak. Starting with Astral. So this is one company where delivered very strong earnings in FY21 and FY22. We have seen some kind of muted top line as well as margin performance in the last 2-3 quarters. The underlying reason for that is that because, as I said, the PVC prices have seen a significant collapse in the last 9 months. And typically, dealers or distributors, they do a lot of destocking, or they go very lean on inventory during that period, because there is an expectation that the prices will go down further. So let me not load up on the prices at this moment when they are high. Let me wait for otherwise I will have to sell at a loss. So let me be very lean on the inventory. So that has impacted the pipe segment, particularly of Astral. And this is also corroborated looking at the results and commentary of the peers like Supreme, Prince Pipes, etc. So channel destocking has had an impact on the top line. Whereas to some extent, adhesives also got impacted because of the weakness in the rural demand, as well as they have one subsidiary where almost 30-40% of the adhesives revenues come from a UK subsidiary. And because of the slowdown in Europe, there has been a sub-impact in the adhesives business. But mostly the impact on the top line has come because of the destocking of the pipes that has happened at the dealer level. And secondly, the impact on the margin is because of twofold. One is when your volumes go down, there is negative operating leverage which comes into the play. So that has impacted. And more importantly, there is also inventory loss. Again, because when the raw material prices undergo significant deflation, so you have to mark down your raw material because you can't, the value of that raw material has come down. So you have to take a markdown on that raw material inventory. So that has also impacted the margins in the last 2 quarters. But having said that, the PVC prices have now stabilized, and we think that both this problem of inventory destocking as well as the inventory loss, we shouldn't see going forward, or it should be very marginal in 4th quarter, but should be almost negligible as we go forward. But more importantly, from a structural perspective, we think Astral is very well placed. So if you look at Astral, they have a very high market share in the core, in the CPVC, chlorinated PVC business, but they don't have the same kind of market leadership in the PVC segment. So what they're trying to do is to address this, trying to expand their reach geographically. For example, they have put recently new facilities for PVC pipes in Bhubaneswar, which will help them cater to the East India, where the presence is very negligible. And these are, from a logistic perspective, the nearer to the market your manufacturing is, the more the possibility of gaining market share, because there is a lot of freight. These are heavy products, so there is a lot of freight cost involved. So if you have a manufacturing setup close to the market, it makes you very much competitive. So Astral has been expanding its pipe capacities in Bhubaneswar. They're also put up new facilities in Aurangabad and Sangli. So we think that they have an opportunity to increase their market share in the PVC also. So PVC is in fact a much bigger segment than the CPVC. So in a bigger market, there is an opportunity for them to gain market share. And Astral has seeded a lot of business in the last 5 years. So I think adhesives has already scaled up quite nicely, as you can see in the table below. But they are also got into paints, and they also got into sanitary ware for like faucets, etc. So that segment has also now started contributing to revenues. So I think faucet contributed something like 30 odd crores in the latest quarter. And we think that there is an opportunity for them to scale up their revenues in these new segments also. So 10 years back, Astral was largely a CPVC company. Now, when we look at this, they got into many new segments. So next, we think that from a next 5-year perspective, there's a lot of opportunity for Astral. And one query we received from the investor regarding Astral is that they got into too many segments. So will it dilute their management bandwidth? What the company has done very nicely is that for many of the business, they have got top people in the place. For example, for the sanitary ware business, they have got ex-CEO of Serra Sanitary Ware. Similarly, when they acquired paints recently, around a few months back, they acquired Gems Paint based out of South India. They were able to retain the erstwhile management of the Gems Paint. So it's not that they are diluting the management. So they are also scaling up on the management. Similarly, on the independent board, it's a positive development that for a mid-cap company, they have got more than 50% independent board now with the recent 2 appointments. So from a structural perspective, we think that Astral is very well poised for the next 3 to 5 years. The only thing that could be key monitorables are the sharp volatility in the raw material prices, because that keeps leads to a lot of volatility in the earnings in the short term. And secondly, we'll again keep on having a close look on how the new businesses they are scaling up, what competitive advantages they are building to become a market leader eventually in these new segments. And moving to V-Mart, again, when you look at the top line number of V-Mart, it's pretty decent. So I think for example, a recent quarter, also 3rd quarter, the top line they grew by around 12%. But when you strip this top line, you'll find that much of this has come from inorganic. So they acquired last year Unlimited brand of stores from Arvind Lifestyle. And recently they made Lime Road acquisition. And also V-Mart has been pretty good on store expansion. So last 3 years, they have expanded store at the rate of 9% CAGR. The weak point is basically the sales per square feet has been a bit muted for VMart. And this is an important element because if you're able to increase your sales per square feet, that is where you'll be able to generate efficiency. That is where your margins will come. That has been a weak parameter for VMart for 2-3 reasons. One is that obviously when you expand the stores, the new stores take a lot of time to reach to the sales level of the mature stores. Given that VMart has aggressively expanded stores, so obviously this ratio, this number has to trend down. But also other reason is that the demand generally has been weak in rural area, and VMart caters largely to the low income groups where there is a definite pinch of inflation that we have seen in the last 12 months, in the last 18 months. Even I think there has been an impact of COVID on the lower income groups. So that has impacted VMart. So definitely there is some demand concern on VMart. And secondly, particularly in this quarter, they also had some one-off impact because of LimeRoad acquisition. So there is one-time integration cost, which also further impacted the margins, especially in third quarter of FY23. But as we go ahead, we think there are some positives. One is that generally, inflation has trended down, as we can see even in the input prices. Inflation has trended down in the last 6 months. And VMart has also passed on this decrease in the raw material price in form of price cuts. So I think that should help. Generally, the inflation has come down. So I think the disposable income of people will increase. Secondly, VMart has also kind of brought down the prices for its apparel. So that should help. Secondly, also VMart year back when cotton prices had increased significantly, they had to vacate the low ticket prices, particularly the 199 rupees apparels, because it didn't make economic sense given the raw material prices to make money in that low segment. But thanks to the cotton prices coming off significantly, VMart has again started refocusing on the low ticket apparels. So we think that this augurs well because VMart has very high kind of brand pull and very high market share in the low ticket apparels, and competition is relatively, particularly from organized players, competition is very, very less in that price point. So companies again refocused back on this low ticket apparels, which should help. Secondly, a company continues to do all the good things from a long-term perspective. For example, digital or online has been kind of a weak point for VMart historically. So with LimeRoad acquisition, I think they are looking to plug that gap in the online space. Secondly, they've also been able to turn around Unlimited in a pretty fast time. So when they acquired Unlimited around 15 months back, Unlimited used to make very low EBITDA margin. I think it was in low single-digit EBITDA margin. But in latest quarter, third quarter, Unlimited has actually been able to do mid-teens EBITDA margin. So that is a pretty sharp improvement in a very short time period. So Unlimited has been witnessing good traction, both in terms of top line as well as margin. So that is a big positive. So key monitorable for VMart is we'll track the market share trends. So how it is trending for VMart after they kind of vacated that space and now again come back in the space, how it is going for them in the last, we'll track the market share because that is very core to the business. And secondly, we will also track how LimeRoad, what is the benefit versus the drag of the LimeRoad. So definitely we're waiting that LimeRoad should start outpacing the drag that benefit should start outpacing the drag that it has been having on the VMart financials. To sum it up for VMart, I think there has been a challenge in the last 12 months, but we are seeing that many of these challenges are abating. So we see a pretty better better days for VMart as we go ahead. Coming to alkylamines, so this is again one stock which had a very rockstar-like performance in FY21, even in FY20 before COVID. FY20 was also a very good year for alkylamines. That continued in FY21 and first half of FY22. But last 1 year has not been as great as what we had seen in the past. There are two reasons for it. One is that obviously COVID-related, alkyl benefited from COVID-related revenues. So alkyl amines went into many of the COVID drugs like molnupiravir, etc. So that demand has tapered off significantly in the last 12 months. So that had an impact. Secondly, what we are hearing, particularly in the pharma space, is that there's a lot of a destocking which is happening even in the pharma space. Again, because of the same reason. One is that during COVID, many of the companies or distributors or the supply chain had built up on the drugs, generally speaking, even on the non-COVID drugs. So there is a bit of high inventory in the system. Secondly, also because of the falling raw material price environment. There is a tendency of dealers to go lean on ordering or having inventory. So both this impacted both these three things: COVID-related demand tapering off. Secondly, destocking, the high inventory in the system during COVID. And third is the destocking, which is happening because of the falling raw material prices. So all these three things are impacting Alkyle's revenues in the last 12 months. Also, what happened is that the new capacities of Alkyl came up maybe at the wrong time. So they kind of increased their acetonitrile capacity somewhere in early part of this year. Last year. So that capacity came up. And secondly, they're also expanding the ethyl amines. I think competitor Balaji Amines came up with the new ethyl amines plant. So demand ek to kam ho gaya, but whereas the supply increased in the system. So as a result, there is a pricing pressure on a couple of the products, acetonitrile as well as ethyl amines that we are seeing in the last few quarters. So that has had an impact on both top line as well as on the margin front. But despite that, all the negative things that said, you will find that the EBITDA margin at 18% is still a very healthy numbers actually. And in fact, it is similar to what Alkyl used to make pre-COVID. So if you look at Alkyl's EBITDA margin average between FY15 to FY19, it was almost between this range, 18 to 20%. So that goes on to show that the company is much better than what it was 5 years back, despite all the supply demand gap that we are staring in the last 12 months. The EBITDA margin, worst case EBITDA margin, we are close to 18%. But we remain very positive on the company. One is that we think that end of the day, companies catering to pharma, agrochemicals, generally chemicals demand. So that is fairly resilient. So demand should come back, should normalize going ahead. Secondly, we think Alkyl is doing all the right things. So it continues to, hallmark of Alkyl has been, it has left very little room for competition. So it has always reinvested back into new capacities, etc. So it continues to do that. In other words, leaving very little room for the competition to come in, because there is a long gestation period. Because if a player decides to set up an amines facility, first of all, you have to get environmental clearance. So that takes a lot of time. Secondly, it's a highly process-oriented industry, very high capex requirement. So you have to reach a very high utilization level to make money. So that also kind of pushes ahead the number of gestation period. So Alkyl is relatively leaving no room for the competition. So that is positive thing. Secondly, we also believe that the company's cash generating profile is much stronger than what it was 5 years back. So around 6-7 years back, company used to generate something like 50-60 crores of EBITDA per year. But now, even in the last 12 months, despite all the headwinds, I think we are looking at EBITDA of almost like 200 crores per annum. So in other words, the company has opportunities to grow beyond amines. Traditionally, the small size of operating cash hindered its expansion beyond amine derivative. But given that now there is a massive cash generation in the company, it can target the broader pharma intermediate space. So the company is much well structured than what it was 5 years back. And lastly, when you look at the numbers in third quarter, you'll find that the gross margin has improved significantly compared to the last 1 year. But the other expenses where actually you'll see that there was no, it's been trending up. That is because the power and fuel cost, it took us a lot of steam in this industry during the process, during manufacturing process. So power and fuel cost actually kind of impacted the other expense. And hence, if the gross margin would have fully translated into the EBITDA margin, we would have seen north of 20% EBITDA margin. but because of the higher power and fuel cost, that didn't translate. But as I showed in the one of the previous slide, even the coking coal price, it has not come off like other commodities, but nevertheless, compared to its peak prices, it has come off like 20%. So we think that going forward, this line item we should see an improvement in this line item from alkyl. In other words, we should see some margin improvement for alkyl going forward. And coming to tar sands, so tar sands again is one company which benefited during COVID, because when you do PCR testing, you need lab consumables, etc. So tar sands supplies that. So definitely there is a, I think 15 to 20% boost in FY22 revenues because of COVID related revenues. So that has completely gone off, and hence we are seeing that the recent quarter revenues have got impacted because of that. Secondly, like in the pharma side, even in the lab consumable side, there is a lot of stocking which happened during COVID, because I think people are believing that COVID will last forever. So that inventory destocking is also happening, and hence that is impacted. Particularly in the export side, you'll find that there has been a pretty sharp drop in this quarter. So what channel checks are saying is that there's a lot of destocking which is happening in the labware space. So that got that impacted. But again, tar sands, we remain very positive from a 3 to 5 year perspective. One is that the company is getting into new products. So right now they are catering only to around 50% of the labware market. So they're getting into higher value added products like PCR and cell culture, which are high margin products, high realization products. They're also putting up a new facility, especially for these products. So that should start contributing, I think, revenues in the next 12 months or so. And the value proposition for tar sands is similar in the other products, like in the other products. Basically, they will compete against MNC, offering near about the same quality at substantially lower prices. So we think that there is good odds of tar sands succeeding even in this space. So that will automatically double the addressable market for tar sands. And secondly, in the export markets, leaving aside the short-term pain, export market is a big opportunity, because like it's like a drop in the ocean. Tar sands is like a drop in the ocean when you look at the size of the export markets. And again, here the Chinese presence is pretty much high. So as we have seen in other sectors also, there is generally a tendency or thought from the customers that they want to diversify their procurement more and more away from China. And tar sands look, given its premier position in India, it looks very much kind of a natural beneficiary of that, that shift that has taken place, that is taking place, and that will continue to take place in the foreseeable future. The company is also integrating, despite making very good margins. I think the company remains very hunger for making more margins. So they are also investing in a couple of important backward integration projects, particularly sterilization. So far, the company has been outsourcing the sterilization. So they are also investing into new sterilization factory in one of the new facilities. So that should also help from a margin perspective. And last talk which we'll cover is Amritanjan. Again, Amritanjan, unlike its performance in FY21 and first half of 22, last 4 quarters has been a bit weak for Amritanjan. Again, here the same story. During COVID, people used to mix balm with water while taking steam. So as the COVID cases have gone down, I think that incremental demand that the balm segment saw during COVID times, that has vanished. Similarly, here also the story is about little bit about destocking. The channel had loaded up on balm stocks around a year back. So now we are seeing that kind of destocking which is happening. So that has also impacted the revenues. On the EBITDA side, company continues to investing in advertising and sales promotion expenses. Just because of the momentary drop in the revenues, company has not stopped investing in the business. So they continue to invest in advertising and sales promotion expense. So there is a double whammy. One is your top line has sold, but the company has, keeping in mind the long-term picture, they had continued to invest in the business. So as a result, you will find that YOY, there is a sharp drop in the margins from more than 20%. The margin in the most recent quarter has come down to 12%. Whereas Comfy continues to do well. For the 9 months, I think Comfy was up around 15%. So for Amritanjan also, the key monitorable is we'll continue to see how Comfy is shaping up. So I think they have done very well so far in one state, Orissa. So we have to see whether Amritanjan has in it to succeed beyond Orissa, because Comfy to become profitable, it has to scale up beyond the current revenue run rate of something like 70-80 crores per annum. It has to scale up significantly from the current levels, and for it to successfully scale up, it has to also start making mark beyond the state of Orissa. So this is one where we keep a very close eye how the market share of Comfy is trending in other states beyond Orissa. Also, I think you may be aware that recently the company came up with a press release that there is a service complaint that the company received regarding some of employees benefiting personally at the expense of the company. So we will wait for the I think the company has commissioned Deloitte to undertake a investigation of this complaint, get into the roots of it. So we'll wait for the observation of the Deloitte, what report has to say. But generally speaking, historically, what has given us comfort regarding Amritanjan's account is that their cash generating ability. So, for example, it's one of the rare company where consistently for the last 5 to 10 years, the cash conversion has been more than 120%, 130%. You'll find very in rare companies that the cash conversion ratio is so much high. So that gives us comfort. Secondly, in the last 10 years, you look at Amritanjan's accounts, there has not been a single year where they have generated negative free cash flow. So that also gives us comfort. Another thing which gives us comfort is that their balance sheet doesn't have debt. In fact, they have almost 200 crores of surplus cash on the balance sheet. So company, if any company which has such good cash generating profile, थोड़ा difficult होता है believe करना कि there will be a lot of siphoning or gold plating that would be happening in this company. But nevertheless, we will wait for the outcome of the forensic investigation. So once the company makes public the report, we'll go through it and we will take the necessary action that we need to take. And just to cover off, I think Page, my colleague Rakshit Deven had discussed this in detail in the CCP webinar that we had on just about last Friday. So I'll not get into that detail over here, but would be suffice to say that Page maybe there is more about temporary weakness because of the ARS implementation that they are doing. I think Page reported something like a -12% volume growth in third quarter, adjusting for ARS, where basically the dealer level ka inventory is getting normalized. Adjusting for ARS impact, the volume would have been flat. And secondly, there is also some impact of COVID in Page. It's a little bit difficult to believe, but during COVID, many of us were working from home. So the athleisure demand had gone up significantly. So as people have now started working from office, so that demand has normalized. So some bit of base effect of athleisure also, which is impacted. But the good thing about Page is that when you look at the competitor numbers, so they are really in, you can see the difference in the numbers between Page and the competitors. So competitors really seem to be in kind of shambles. And so Page is relatively speaking very significantly better placed than the competitors. Secondly, the company again has seen a lot of structural changes in the last 3 years. Obviously, ARS implementation will benefit the company from a long-term perspective, kind of bringing down the working capital days. So Page has almost more than 100 days of working capital, inventory days to be specific. So I think with ARS implementation, that working capital days should see a significant moderation. So in other words, the free cash flow generation ability of the company should see significant improvement. But also what the company has done is that they have expanded significantly their distribution footprint in the last 3-4 years. So I think many of the distribution should start having the snowball impact and should start delivering very good volumes. Again, Page is one company which has been at the forefront of technological implementation. So some of the examples we are given in the slide. So in other words, Page again, when you look at the relative picture for Page, when you look at the things that they have they've done in the last 3 to 4 years, we think the future is quite bright for this company. And Dr. Lal, again, this company has been discussed in detail in CCB webinar. But again, Dr. Lal, the headline numbers for third quarter got impacted because of the COVID-related base that we have. The non-COVID revenues have grown at 9 to 10%, and the last 3-year compounding again has been close to 9 to, in fact, it's almost in double digit. The only thing, if I have to point out a weakness in Dr. Lal's result, is the non-COVID revenues. Before COVID used to grow at something like 15-16%, which has come down to 9 to 10%. So we are doing more and more channel checks to understand, why this number has come down. There could be probably two possibilities. One is that some of the small mom and pop stores, they benefited significantly during the COVID. So obviously there could be some market share loss to the small mom and pop stores, diagnostic centers. And secondly, that generally, there are reports that, people are falling less ill, etc., because COVID vaccine or whatever, they have become more conscious. But nevertheless, what we see when we look at the overall penetration of the diagnostic industry in the country, it's very hard to believe that we will go on single digit. I think the long term, we should again revert back to growth in double digits. And more importantly, Lal is competitively is very well poised. For example, despite being the largest player, when you compare Lal's number with the other organized players, for example, in the table in the right hand side, you'll find that there is significant divergence than what Lal's revenues are growing and or the other organized players' revenues are growing. In fact, what we are also hearing now is that, given that the COVID-related demand has now ebbed off, many of these small diagnostic players who benefited during that time, now that COVID wala avenue nahi hai. So now they are finding the things going a bit challenging. In fact, I think today there is a Business Standard article which is also kind of dwelled into that point that now even the new age players, everybody is looking at increasing the prices because there is no more benefit of COVID, extra revenues that Hitarto gave you a kind of enabled you to price your product competitively. I think that that avenue has gone, and hence even the new age players are looking at increasing the prices. So from a competition perspective, we think that Lal is very well placed. And secondly, I think Suburban, last 12 months, Suburban, there is an integration which is happening. I think things are falling in place even at the Suburban level. I think there is a new reference lab which has been opened up for Suburban. So that actually strengthens both the front end in terms of the product offering, in terms of the test menu that Suburban has, as well as in terms of increasing sweating of the back end, basically. For example, for every I think when you look at the Dr. Lal's productivity and Suburban's productivity, there is a significant difference. For example, for every lab of Dr. Lal, there is 7 kind of centers, front ends. Whereas when you look at Suburban, its ratio is only half. So with this new focus, with new backend, new reference lab, etc., we think that there is an opportunity for improving the EBITDA margin profile of Suburban to bring it in line with that of Dr. Lal in the coming years. So that's it. But just wanted to leave before ending is that these things, the temporary concerns that I pointed out for some of the portfolio companies, it is nothing new. That at the end of the day, it is business, so it will have its own cycles. But the company, historically, the portfolio companies have faced it very nicely. Basically, they have not stopped investing in the business because of the temporary weakness. In fact, they have used these temporary slowdowns to their advantage by focusing on the business, by looking closely at the business where they can generate efficiency. So the portfolio companies historically have come out very strongly out of the crisis or temporary crisis. They have come out very strongly, and that is reflected in the earnings as well, earnings recovery that we have seen historically. For example, some of the examples are given in this slide. So for every temporary drawdown in the earnings, the subsequent period has been a fast recovery period. So they have not only recovered what they lost during that period, but in fact they went on to generate healthy profits, and that is also translated into healthy share price compounding in the subsequent years. So I think I'll stop over here. I think we can start the Q&A session.
Thanks, Ashvin. That was quite elaborate. So folks, we've got quite a few questions in the Q&A box, but if any of you want to add to that list, please find the Q&A box at the bottom of the screen, and we'll be happy to take as many as possible. So first, we'll take a set of questions at the portfolio level before getting into stock-specific questions. I think the elephant in the room, in some ways, is the PE chart that you showed clearly is triggered some questions. In your chart, if you saw that the PE had gone up to 50 plus, so whilst it has come back to the current level, does that mean that a year ago, 15 months ago, these were highly rated and it was natural for these companies to derate? How do we justify getting into these portfolio stocks during those elevated levels?
Okay. I think that's a good question. So obviously, when you look the period between FY18 to FY22, the PE had definitely re-rated, I think something from 30 to 50 odd levels or 56 odd levels. But as we have said in our earlier calls, so we don't basically use headline PE as a measure for determining whether the company is actually rich in valuation or it is cheap in valuation. But in fact, as I said, like many of the companies have seen significant business transformation in the last 5 years, whether it is their FCF generating ability, or from being a small concentrated player to much more diversified, bigger players having a foot kind of presence across markets, across client base, across product segments. So we think that kind of re-rating which we saw between FY18 to FY22 was very much justified because of the structural improvements in these companies. So that is one reason. In fact, if you look, if I had to use FCF as a measure instead of EPS, even though I don't have the data at this moment, but I'm pretty sure that that re-rating would have been significantly lower, if any, between FY18 to FY22 if I had used FCF per share as a metric. So that is another thing. And thirdly is that, just for your information, so for the Rising Giants portfolio, the average longevity that we have for the portfolio companies at the average level is close to 13 years. And we are projecting that long-term free cash flow generation should be close to 23%, 20 to 23%. So anybody can do their maths. So if we are projecting that kind of free cash flow growth rate for 13 years, the fair value PE should be anywhere close to 70 to 80x. So even at 50 or 56 levels, so we had a pretty big headroom as far as the intrinsic valuation of these companies were concerned. And that has become all the more attractive now, given the derating that we saw in the last 12 months. In other words, in short, basically FY22 may that re-rating which happened between FY18 to FY22, we very much think that that is justified because of the improvements in the business or the fundamentals of the companies, the business model of these companies. Secondly, even at FY22 peak, the levels of PE, we had significant headroom between the intrinsic value and that prevailing PE of these companies.
Fair point. So I think that leads us to the next question, where you can elaborate on this aspect of intrinsic value and current prices. The questions around, fair enough, fundamentals have performed well and stock prices haven't. That means that clearly there's an opportunity to invest or top up, as you have suggested. For those perhaps who don't have the ability or the liquidity to top up at this stage, how are we helping them by taking care of or taking advantage of this anomaly in the portfolio, that certain stocks have fallen more than their fundamentals? Related to that, questions around some of the trades that we've done in the portfolio of late. People can see those trades. Naturally, it's related to the rebalancing that you're going to talk about. So they're a bit confused about what we are trying to do here in terms of why we're buying something and selling the other. So if you could just elaborate on this whole rebalancing process, which in turn is linked to your assessment of intrinsic value and current stock price, which in turn can explain the actions that our clients are seeing in their demat accounts.
Yeah. So basically, what we have done is that we have recently implemented MOS framework. I think you must have heard colleagues Rakshit or even Pramod Saurabh talking about it. So around a couple of months back, or rather 3 months back, we implemented MOS framework for the Rising Giants portfolio, also for the Little Champs portfolio. So what this does, that every stock in the portfolio, they don't fall or rise in an even proportion. So some stocks maybe fall more, some stocks may rise. So what does it lead to is that it creates a different degree of margin of safety for every stock in the portfolio. For example, if the intrinsic valuation of all the stocks remain the same, but the market price of a stock falls by say 10%, 15%, it creates a higher MOS or margin safety in that particular stock. In other words, given that our position sizing framework is now linked to MOS, the extent of the MOS, margin of safety in that particular stock, so the stocks which fall the more, naturally, they will see a higher allocation than what it was previously. So we have implemented this couple of months back. We do the rebalancing on a fortnightly basis. So if there has been pretty sharp share price movement in that 15-day period, you will find that that stock we will most likely buy after 15 days. So as a result, you will find that generally the churn has increased in the last 2 months. Obviously, there was one-time implementation impact also. Particularly, many of you would have seen in first week of January, particularly, there has been a lot of buying and selling. That is because whenever we do this implementation for the first time, there's obviously a bit of churn. But then, on a fortnightly basis, I would say that that churn would be relatively lower. But this kind of tool gives us an opportunity to invest more into the companies where the fundamentals are rock solid, but because of the near-term market, whatever concern or noise, the share prices have kind of, or quarterly results for that matter, the share prices have come off significantly. This tool, this framework or tool gives us opportunity to invest, buy into these stocks. And obviously, to buy that stock, we have to trim somewhere else. Given that there is no fresh inflow into the portfolio, we have to trim somewhere else in the portfolio where the MOS is relatively lower compared to this particular stock. So we'll feel that kind of buying and selling. But again, compared to what we saw in the first few days of January, when there is a first time implementation, the churn we believe should be relatively lower going forward. Pramod, you there?
Yeah. Can you hear me?
Yes.
Yeah. So another aspect of this is,
I think Pramod has dropped off. Hardik, do you mind checking with Pramod?
Yeah, I'll just check.
Yeah, Pramod.
Yeah, so sorry, I just dropped off. So there's this question around, we do engage with management in terms of advising them or sharing our thoughts in terms of capital allocation, improving or strengthening the operating processes, strengthening the management team through issuance of ESOP and stuff. Is there scope for us to advise management teams to initiate a buyback if we believe that these stocks are depressed in terms of prices as compared to the fundamentals, which can obviously boost total return for existing investors?
Yeah. Yes, I think that is an ideal solution, particularly for companies who are sitting on the cash. But the only thing is that we didn't get an opportunity because last 24 months, in fact, most of our portfolio companies have gone very high on investments. So just to give you some examples, for example, this is for the Rising Giants portfolio. Through COVID, these companies have doubled their investment. So in FY22, the investment at the median level for the portfolio reinvestment basically was almost twice that what it used to be before. So these companies have in fact gone through the other route basically. So what has done is that COVID has actually put many of the competitors of these companies, not only in India, but even globally, out of the business or made the business, they are not able to survive that. So these companies have actually bought a lot of these companies. So in fact, in the last 2 years, we have seen a kind of inorganic acquisition. जो पहले 5-10 years में होता था, we have seen that happening in the space of last 2 years. So basically, In other words, when the companies are investing so much into the business, I think there is very little room, for us to advise on buyback. Nevertheless, I think a couple of the companies like Garware, which has asset-light business model, it has done a couple of buybacks. So I think they did one round of buyback around 1.5 years back. They also, I think, few months back, just about 2-3 months back, came with another buyback offer. Suprajit also, I think, came up with a buyback offer around 1.5 years back. But the point is that I think on capital allocation, these companies remain on the mark actually. So there has been, honestly speaking, very little. I think we could have advised them.
Great. So, an extension of the question around the P multiples and valuations and stuff is, whilst we see the intrinsic value being significantly greater today as well as at the time of purchase, why do we think we can see better than what the market is seeing? Where is the delta? Of course, you're not supposed to know what the market is thinking. How are we supposed to know? But what do you think has led to this derating, which in turn also means that the gap between the intrinsic value and the price has only gone up?
Obviously, one reason is that, obviously, as I said, like FY21 and to a large part of FY22, the growth for many of the companies looked superb. So I think in the last 12 months, particularly for around 1/3 of the portfolio, we discussed that companies in detail. I think that growth had come off. I think I think market has kind of extrapolated that temporary weakness in the result to a long-term picture, and that is the nature of the market. I think marketplace pays a very high importance to quarterly results. Even though 1, 2, or even 4 quarters for that matter doesn't contribute much to the intrinsic valuation of a company. Even if you assume a life of a company is 10 years, 1 year period shouldn't be contributing more than 10%. But I think market plays too much importance to the quarterly numbers. So I think that is one reason. But otherwise, I think when you speak relative speaking, obviously last 1.5 years, the companies which have done well is the companies that you are starring on the slide in the screen in front of you. So typically these are PSU companies or energy infrastructure companies, commodity companies, where our investment philosophy doesn't allow us to invest in these companies. And these companies have what has done well in the last last 12 months. So combining both the reasons, one is that I think there has been unwarranted drawdown in some of our portfolio companies just because of temporary weakness in their fundamentals. Secondly, relatively speaking, the companies which have done well in the last 12 months in the benchmark is companies where we typically don't invest for a variety of reasons.
Yeah, I think just to add to Ashvin, I think it is important to understand the edge that we are playing in the market. Every investor has an edge, and our edge is solely based on longevity. As most of you know, market has all types of investors. In fact, recent data suggests a lot of the liquidity in the market is driven by more short-term investors, and therefore we believe our edge is, if we can focus on the long-term longevity of the cash flows of the business, we will be able to have a better handle on the intrinsic value than the market. The market, by its very nature, is bound to react to shorter term effects like this. So whilst it's not the most pleasant experience for any of us, I must admit we were all disappointed, but it's our job to keep our heads down, focus on the fundamentals of the business that we can track. And as long as our assessment of these fundamentals and the longevity of these fundamentals are intact, we think we will be able to deliver a decent outcome for our investors over time. One aspect of capital allocation you mentioned, Ashvin, you said companies have done well on capital allocation. How do you explain companies, say, like Alkyl or Tarson's, who've gone on a capacity expansion spree based on the boost they got during COVID, right? You very well knew that COVID is not going to last forever. I mean, you can argue that none of us do actually, but extrapolating that demand and putting up capacity to see this double headwind now that demand's fallen off because of the excess capacity, you're facing pricing pressure. Does that qualify as sound capital allocation? Could it have been any different?
So the main reason is that I don't think that that capacity expansion would have been driven because of the COVID. In fact, to put a acetonitrile plant, which came, I think, online for alkyl 6 or 7 months back, the planning would have gone at least 3 to 4 years back, so pre-COVID. So as I said, like there is a long gestation period involved here. So you have to get the environmental clearance, which itself takes, I think, maybe 2 years or so. Then ordering the equipment, installing it. So I think none of these companies, I believe, would have gone in for capacity expansion because of the COVID boost. In fact, many of these capacity expansions were planned well before the COVID. In fact, Arsons also, the new capacities that are coming in, that is also for getting into the new products. So it's not purely for expanding the existing capacity. It's also for getting into new products like PCR. So PCR is not only used for COVID testing. PCR is a much larger use also in broader diagnostics or pharma industry, plus also the cell culture. So in other words, I don't think that these companies historically also, for example, alkylamines, so you can see the slide in front of you. Alkylamines during the previous slowdown also, their capacity came on stream amidst overcapacity. Coincidentally, the capacity for acetonitrile as well as methylamines came in 7 years back when there is a slowdown or overcapacity in both these products. But that didn't stop the company from putting a pause to this capacity expansion. In fact, what we are seeing is that as the things normalized, this capacity expansion held the companies in very good stead. And we know that, alkyl revenue really, went into a completely different trajectory after the commissioning of methylamines plant in Dahej. So in other words, we think that this company's capacity was not specifically designed for because of the elevated demand during COVID. It's kind of the long-term plan that these companies have of catering to the long-term demand of the industry.
Fair point. Just moving into the stock-specific section. Say, let's start with Amritanjan. On a fundamental basis, is there anything to suggest that there is loss of market share if we were to compare it with competitors on the pain side, which is to compare it to Zandu or Vicks? Is there anything to suggest that the company is losing competitiveness?
No. So in fact, Vicks is not a competitor. Vicks has kind of a different category. Even though I would say maybe that's why that some small population may be using Vicks even for headache. But generally, Imami is a kind of a pure play competition. But when you look at the Imami numbers, whether for the last quarter or last 12 months or last 3 years, last 5 years, it's not significantly different than Amritanjan actually. So numbers are, they go very hand in hand. So Imami separately discloses it's a very big organization, but separately discloses the number for Zandu segment. So the numbers are actually very much, they go hand in hand with that of Amritanjan. And neither in our channel checks, we have received any feedback that market share is the main reason for the drop in the revenues. So we think that there is an overall slowdown in the overall pie itself, rather than the market share loss.
Right. Okay. We haven't talked about GMM Pfaudler in this call. A little bit of a bit on that.
Okay. So let me bring up the slide for GMM. Yeah. So GMM again, the numbers continue to be very solid. So as you can see, the last column, 9 months number, they achieved almost more than at the console level what they achieved full year in the 9 months itself. So even in the latest quarter, if you set aside there are a couple of exceptional items. One is that they had forex borrowings, which because of the euro appreciation versus dollar in this quarter, there was an adverse impact in the other income line item. Also, they had one order which was to be dispatched from UK to China, but didn't get clearance from the UK government. So there is a kind of a conservative one-time hit taken by the company related to that. So if you strip out that exceptional item, I think the numbers, operational numbers were pretty strong, double-digit growth. Only one maybe weak point in the result was that the order inflow, specifically for third quarter, was down compared to last year. But again, our take is that it's quite may not be very meaningful to track order inflow on a quarterly basis because it tends to be very, very volatile. When you look at the 9-month order inflow and compare it with the last year 9-month order inflow, it's pretty much strong. Like it was, I think, up almost 16% on a YTD basis, 9 months. Despite all the acquisition, also GMM continues to, the balance sheet continues to be in good shape. I think that debt equity ratio is something like 0.7 or 0.8x, and despite all the acquisition that has been made by the company in the last 2 years. So in other words, fundamentals remain in a very good shape. There has been a couple of, I think, investment concerns surrounding promoter selling their stake. I think we addressed that in the last webinar, but just to quickly touch upon that. I think it was very well known to the market that DBAG will eventually exit the company. I think the turnaround of international subsidiaries has been made pretty faster than what was originally anticipated. So instead of the original expectation that it will take 3 years, the turnaround in the international margins has been quite faster, and hence I think DBAG exited in 2 years rather than 3 years, which the management had earlier guidance. The Patel family stake in the company remains where it is. In fact, as per the recent press release, Patel family is slated to buy, or I don't know whether the transaction is already consummated, but they are slated to buy 1% from DBAG. In other words, the company, the promoters who are in charge of running the show at GMM Folder, their skin in the game has only increased in the last 2 to 3 years. So we remain very comfortable about the company.
Right. Just to reiterate, it's not the promoters who've sold. Promoters have only increased their stake. It's a financial investor with a shelf life of the fund who had to eventually exit, and it was pretty well known to the market. Another stock we haven't talked about today, Ashvin, is Suprajit. Is there any issue in terms of cash generation there that you've seen? And a broader question is around exposure or vulnerability to electrification of automobiles.
Yeah. So basically, the stock which you are not talking upon, you can assume that those companies are doing very well. Actually, we talked about stocks specifically where there were some concerns. So Suprajit, again, I think quarter back, I think there is concern about the margin performance at the LDC business, light duty cable business, which they had acquired from Kongsberg around 9 months back or 12 months back. I think in the recent quarter that LDC's margins have really come back. For example, it has improved from -1% in second quarter to 4% in the latest quarter. So I think the measures that have been taken by the company in terms of basically back-ending production to India, essentially, that are bearing fruits. So I think turnaround in LDC is a big positive from the recent result season for Suprajit. And on the other businesses, particularly the core automobile cable, domestic automotive cable business, Suprajit continues to grow ahead of the industry. So despite the two-wheeler industry not doing so well in the last 2 years, I think the core automotive cable business, domestic cable business, continues to grow in double-digit revenue. So thanks to Suprajit gaining market share, also thanks to higher and higher adoption of the cable business in the aftermarket. So more and more organized players are gaining market share from the unorganized segment in the aftermarket business. So this continues to help Suprajit. And touching about the larger electrification, I think there will be some, no doubt, impact on the cable business. So as per our calculation, there could be something like a 15-20% hit to the cable. Some of the cables will become redundant once the electric business comes in. But what Suprajit has done very nicely over the course of the last 15 years is that it has diversified away significantly from two-wheeler cable business, which is the most prone to electrification. So around sometime in FY10, FY9, two-wheeler cable used to contribute almost 90% or 95% of Suprajit's cable. But thanks to the acquisitions that the company has made over the last 5-7 years, now two-wheeler cable business contributes to only 25% of Suprajit's overall revenue. So basically, the impact of the disruption has become very negligible thanks to the diversification that this company's thanks to the diversification that Suprajit has made. Secondly, the company is also getting into new age products like digital instrument cluster, e-throttle. They already set up new tech center called Suprajit Tech Center around a couple of years back. And this business is also scaling up. I think they already got a new digital instrument cluster in place, which is up and running since the last few months. And I think that business will also scale up nicely over the course of next 3 to 5 years. So not only are those products EV proof, but they also have much more higher realization than the cable business. So I think whatever loss that Suprajit will have because of the electrification, particularly in the two-wheeler business, I think that will be more than made up thanks to the new products that the company is developing. So again, not any cause of concern in this company.
Right. So there's a new addition in the portfolio, Prudent. I'm not sure if we talked about it in the last webinar. Can you just take our clients through the investment thesis on it, particularly given what's happening in the mutual fund distribution space with a lot of new age tech companies trying to push through the direct model? How do we see this company in that context?
Okay, so Prudent, only my request is that maybe we have still not mentioned about this in the newsletter. So maybe we'll just publish our rationale once in the newsletter, and maybe in the next webinar we can discuss this in detail.
Fair enough. In terms of the two engineering R&D companies that we have, LTTS, L&T Technology Services, and Tata Elxsi, seems like it's like an Asian merger sort of a combination, both companies in the same sector. How do we justify two companies and similar, and how are they different? Do they end up competing with each other?
Yeah, I think there is definitely some overlap, but a large part of businesses don't overlap with each other. Engineering R&D is a broad field. There are many industry segments over there. So Tata Elxsi is largely into the starting point, basically more into the product design and product development end of the R&D, engineering R&D, whereas LTTS is more into the go to that sheet. Yeah, LTTS is more into the kind of more advanced stage. Basically, it is to some extent journey starts from product development and more towards the maintenance and life cycle management of the product. So in a way, there is a kind of a distinct overlap as well as little bit of distinction between the business. Also, from a segment perspective, Tata is more focused on telecom, auto, media, whereas LTTS is much more broad-based. For example, they are present across transportation, engineering, medical devices, etc. So both from a kind of the business model perspective as well as from a customer perspective, a large part of the businesses between these two companies don't overlap. So we think that both the companies can coexist and grow nicely without stepping on each other's toes.
There was a question on Poshak. Again, there seems to be some decline in free cash flows. So even on a price to free cash flow basis, the valuation don't look that attractive.
Okay, so Poshak, mainly the reason is that because they got the permission to expand their capacity by nearly 3x. So the capex that you see is they had to do this instead of being a modular expansion, because they actually increased their capacity by 3x. And hence you saw this, that particularly I think in FY22, the free cash flow generation had a very big slump, primarily because they went in for nearly 3x capacity expansion. In other words, we think that the next 5 years at least would be like they don't need to do any capex. I think they already got this capex in place, 3x capacity. So the free cash flow, the cash generation should be pretty strong, at least for the next 5 years. So we'll see the picture completely different in the next 5 years.
Fair enough. So I think that's it. We have on the stock specific questions. I think there are a few important questions worth going back to around valuation rebalancing. So firstly, in terms of rebalancing, whilst we can see the benefits of this, have you factored in the net benefit after taking into account the increased transaction cost and the taxation that could likely get incurred?
Yeah, so as I said, like when we implemented the MOS for the first time, you will see that there is a bit of a churn, but on an ongoing basis, we don't see that churn to increase significantly than what maybe, so we have been guiding like 15% kind of churn in the portfolio. It will increase by 500 basis point. But given the sharp price movement or the volatility that we have been experiencing in the market in the recent months, I think clearly the return that we should generate should outgrow the incidental expenses, whether it is tax or whether it is other expenses. Mind you that tax you actually eventually pay only when you actually make profit. So tax is not 100% of the profit. So tax is kind of a portion of the profit. So definitely we think that the benefit from doing implementing the MOS and rebalancing should be much more than the tax, which will be a fraction of the benefits that we will generate.
Right, fair enough. So in terms of the returns, given that, given this drawdown that we've had, especially the RGPMS, literally from inception, how do we see the portfolio catching up? Because, you'll have to do a lot more heavy lifting to get back to where we started from. And on top of that, deliver the sort of returns that we expect. Is there any change in our thinking on that?
No, we continue to maintain that, but because what we have historically seen is for this portfolio on a 3-year period basis, even though there will be disconnect on a 12-month basis, 15-month basis between fundamentals and between the share prices, but on a longer term time period, the fundamentals and returns, they do converge. And over a 3-year time period, I remain very confident that eventually the share price returns as well as fundamentals will converge. That we have seen historically in the portfolio companies itself. For example, FY19 to 22, the share price return for the portfolio has been pretty strong, both on an absolute basis as well as on a relative basis compared to the benchmark. And you know that during that period also there were periods of ups and downs. For example, during the COVID first wave, there was a steep drawdown in the portfolio, but eventually the returns did come back quite sharply. So even though I think for the RGPMS, a 15-month period has elapsed, but still I remain confident that over a 3-year period, the share price return should converge to the fundamentals. In other words, there should be a sharp recovery in the returns for the portfolio.
Fair enough. There's a question on, do you still believe in buying it at any price? Whilst we've never said that, we maintain that the PE metric is not the appropriate metric to value a company. Besides that, I don't think anybody at Marcellus have said you should buy at any price. In fact, the MOS framework that Ashvin talked about clearly talks about an assessment or estimate of an intrinsic value. That means that there is a value ascribed to every investment, and that investment is made only when the price is below our assessment of intrinsic value. The difference is, unlike the majority of the market, the intrinsic value is not arrived based on a PE ratio, which at best captures that year's earnings. Whereas the textbook definition of value is the present value of cash flows to perpetuity. Therefore, the longevity makes a big difference in our assessment of the value and the market's assessment of the value. Whilst I clarified that, Ashvin, worth clarifying another pertinent question from a client was saying that I presume you use some element or some version of discounted cash flow to arrive at intrinsic value. And the client makes a valid point that, look, I don't know what my free cash flow will be in my personal P&L 12 months from now. How do you intend to get a handle on the free cash flows of businesses which are facing real-term uncertainties in the real world? And therefore, how can we rely on such an estimate of an intrinsic value based on what are clearly uncertain free cash flows?
Yeah. So one is that we are valuing business not for the short term. We are valuing from a long-term perspective. And unfortunately, I don't have the longevity framework, but the longevity framework kind of answers your question. So we look at different elements of the company which can sustain its free cash flow for a long period of time. One is that how strong the moat of the company is, and again, it's not based on any kind of whims or fancies. Actually, our analysts do very hard work inquiring the management, doing extensive channel checks. So there is a proper framework how we arrive at the moat score. Then how agile the management is. Are they on their toes all the time? Are they investing back in the business? Are they getting complacent? Are they aware of the disruptions, potential disruption? How well have they dealt with disruptions in the past? How successful they have been on that front, etc. So we look at the lethargy, and finally institutionalization of the business. It's quite obvious that if it is a one-man show, the longevity of that business will be pretty limited. So how well institutionalized the business is, what is the quality of the professional management team in the company, how the quality of the board of directors, how well incentivized are the employees in the company. So basis that we derive the longevity, and obviously for the free cash flow estimate, we're also taking into account what is the industry size, what is the market share, how far can the market share grow, has the company historically demonstrated getting into product adjacencies or expanding their geography, and so on. So all of this, basically, we do only these things actually. So we don't look at share prices, what is it, but our whole focus of our research team is towards getting the company right on this framework, and that is how that gives us the confidence about the intrinsic valuation of the company.
And also, just to complete that, remember we call this framework the margin of safety framework for a reason, in the sense that we do acknowledge that it is a real probabilistic world out there. Nothing happens as we envisage. The margin of safety is to ensure that there is enough scope for errors on that front. So typically, the gap between the price at which we buy and our assessment of intrinsic value is at least 30%, if not more. At this stage, I reckon it must be north of 50%, Ashwin, given the drawdown in several of the stocks. So we do have a scope for error here, and we do recognize in the real world nothing is deterministic, and we factor that through the margin of safety approach. The last question, actually last but one question around, if we want to top up, what would you recommend? I presume a lot of investors would have these same questions. Should I sort of accumulate my savings and buy on dips, as in top up whenever there is a bad outcome on the returns? Or should I take a systematic investment approach to deploying the savings as and when accrue those savings? I think it is a very personal question. We've tried to address this question in the past. We always believe an SIP is a more disciplined savings approach, not necessarily an investment approach, because many of us are salaried individuals, or even as businessmen, we have regular cash flows, which means we have regular savings. As long as your asset allocation is clear and you are viewing this investment of yours within that asset allocation framework, presumably with a relatively longer term horizon, we recommend the SIP approach. But if you think you can time yourself by buying on dips, we would encourage you to do that. The only challenges we see with our own personal investing approach on that front is, often when the drawdown comes, the news flow is not particularly great for us to muster up the courage. But if you do have the conviction in the portfolio, you should adopt that. And secondly, it is quite possible that the drawdown may not come, and we could see a fairly sharp rally in that. In which case, you should be okay to come in at higher NAVs or higher prices. So that's our 2 cents on that approach. And the last question quite a few have asked is Little Champs open for investments? For those of you who have been on our waiting list, you might have got an intimation recently that we are taking in some money, as there has been some capacity created. I think that capacity is still open. So please do contact our sales team at sales@marcellus.in if you'd like to invest in our Little Champs portfolio. So with that, I bring this call to an end. Thanks to all our clients who've dialed in. Thanks to Ashvin for that elaborate discussion on the portfolio, and hope to see you all soon again in the next webinar. Thanks, everyone.
Thank you. Thanks, Pramod. Thank you, everybody.